Everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are talking about, answer a bunch of questions with my opinions. It's going to be health related, wealth related. I think I said health, wealth related, commodity related, or financial topics. Let's dive in and see what people are talking about on Twitter. Again, if you want to follow me at finding_finance, and if you want to join the website, it's finding-value.com, and just use the word discount in the coupon code for discount. So, Blind Luck Project, he says, what is the worst thing that's ever happened to you financially? I don't know. Everything that I've done in my life, I've been prepared for financially. So I've never not had a emergency fund. I've never had anything that's wiped me out or anything like that. So I'd say everything is somewhat expected, and even the unexpected is expected to happen. So I don't know. I don't really have a good answer for the worst thing that's ever happened to you financially. I never have done anything without thinking about it first. So I purchased two homes. I knew what I was getting into. Both were actually pretty good since I bought them at very good times. I've refinanced, and the financing's been good. I've never had gigantic credit card debt. I've had unexpected expenses, but have been prepared for those expenses. So nothing came out of the blue that would have blown me to the downside. I've always been incredibly healthy, always stayed on top of it, working out, eating, I would say partially, pretty good for the most part. And I don't, yeah, nothing's really come out of left field where it's like, man, this is so bad, I can't recover from it. I also think it's partly because I have the mindset that I can bounce back. John Quake says, your curves are looking pretty hot, Uranium. This is the pricing for the intraday spot price of U308, just continuing to go up. This can move quite dramatically, guys, and the equities could go vertical with the price of uranium. So I'm not waiting around. I'm positioned. I'm ready for the move. I'll just say that. So the question of the day, would you rather help a person already investing become a better investor, or teach a non-investor how to invest? It doesn't matter to me. I like investing in general, and it doesn't matter who talks to me. It can be someone who doesn't know anything about anything. A person's like, I don't even know how to buy stocks. What brokerage account should I use, and all that? Or someone who has been in the markets for 10 years and wants to start up a conversation about how, what my approaches and strategies are for investing. I like talking about all that stuff. I'm not saying that I know absolutely everything, and I'd love to talk to other investors to see what their approaches and strategies are. Always willing to learn, and I just like talking about investing in general. Doesn't really matter either one. We believe uranium prices could move chaotically to the upside. Given everything that is happening in the sector, I would say this is very accurate description. That's from the Goring and Rosenzweig thing. It says, our model suggests uranium's strong performance has just started. Uranium has likely reached a pivotal inflection point that could force the price higher by as much as 3 to 4-fold over the next several years. For the first time in history, uranium has slipped into a persistent and widening deficit. We believe the results will be dramatic. And that's what their opinions are. The way that I view this is I purchased uranium when it's cheap against gold, the uranium to gold ratio. Some people think that ratios are hogwash. I completely disagree with them. And I purchased a lot in that September-October timeframe. I've been purchasing along the way, averaging up in my positions into strength. And I do think that we're going to go at some point, and it could be very violent and chaotic. And we could move dramatically higher in very short periods of time. It could be a very hard ride in uranium, where we get lots of volatility. I don't know what's going to come. I don't know what's going to happen. I don't know how volatile it's going to be. And some people will say, "Oh, well, that's not very confidence inspiring." I'm not. I don't, guys. As an investor, you have to be open to whatever is going to be thrown your way. I don't control the outcome. You don't control the outcome. All we know is that it's cheap. Things are moving in our direction. It's gaining momentum. And now is one of the best times to kind of sit on your hands with your investments and just say, I'm going to take it whatever which way this thing goes. If we go up dramatically in a very short period of time, fantastic. If it's a slow, steady grind, then even better. I like the slow, steady grind where we don't get a lot of pullbacks. That's the easiest ride. That's what I would prefer. But guess what? The market doesn't care what I prefer. At some point, what I think is going to happen is it's going to move violently and people are going to FOMO in. That's what I think is going to happen. It says your parents are not an emergency fund. How much money do you have saved in your emergency fund? I don't know, guys. I don't carry a gigantic emergency fund. What I do is I put it in investments. I have enough money to cover me for a couple of months in cash. And then if I have to take money from somewhere else, if I have to sell physical metals, I can do that if I have to. And it depends on how much money that you have and how many income streams you have. The more income streams you have, the less need for an emergency fund because the emergency is really a protection against loss of income. If you have padded yourself with a bunch of dividend paying stocks, you've got multiple sources of income on the side of dividend paying stocks and all this other stuff, I don't see that you really need a huge emergency fund. A huge emergency fund is when you've got a single source of income and you've got liabilities out there where you've got a lot of potential payments on something that could hurt you. So, for instance, I'm so saved up everywhere that I'm like, I'm deep in every single category. So if there's a health problem with anyone in the family, I have insurance. That's my first form of protection is the insurance. I have home insurance. I have insurance, health insurance and dental insurance and all these insurances. So that is one thing that protects me against needing a gigantic emergency fund. I also have a gigantic health savings account that I've invested and done very well in. So I have that gigantic health savings account where all I have to really cover is the deductible on the insurance. So that is all covered from the health insurance side. I have nothing that I need to really save for on that side. And my emergency fund is, I've got a good chunk in that health savings account. Then you look at my other things, it's like, okay, so what payments could really get me? The mortgage is a known entity, but my dividends cover all of my day-to-day, payments. So the dividends can cover my mortgage. The dividends can cover my expenses, and I can also cut my expenses at the same time. So if I lose my main source of income, I can obviously gravitate towards the dividend income and redirect that. Instead of reinvesting it, I would redirect it towards paying for things that I have at my house, my mortgage and my expenses. So what's really going to hurt me besides that? I've got property taxes, I've got some other stuff, but that can also be covered by dividends. It could also be covered by getting another job or something like that. And the fund that I've saved, which is a couple, 3 months, I think, or whatever, can go towards that stuff. So it depends on your situation. It depends if you have those insurances. It depends if you have the savings in the health savings account and all that other stuff. All of it adds up and it matters. So I don't know. I think you get to a point if you're old enough and you've been saving enough that you don't really have to worry about if something were to go wrong. I can also redirect money in my accounts to create even more dividend income if I had to. So I don't know. I don't think for me, I'm almost past this point where it's like it doesn't even matter to some degree. It did used to matter hugely when I was younger, and I always had a big emergency fund. My emergency fund was more like 6 to 8 months in my account because I didn't have the income and the diversified nature of the income to really be where I'm at today. And that I think is something that everyone should strive to get is a more diversified income. And it means not putting all your eggs in one basket. It means having multiple things that pay you. You could have a real estate rental property. You could have dividend paying income. You could have a side hustle with your original job. Some people say I'd rather make their opinion is I'd rather make more money at a single job. I would disagree with that because you're not as diversified. If you could have a side hustle that covers all your expenses and then you just save all of your original income, and then originally the income that you're saving will eventually be supplemented by the dividend income. So it'll replace the dividend income will replace your main job, and that's really where you want to be if you can get there. And there's a lot of dividend paying commodity companies that are just I think are going to crush it. And that is where I think a big leg up on everyone else is to know what to invest in, good chart patterns, big dividend yields, and then just get that dividend payment and just have it pay you, pay you, pay you, pay you, pay you, and then reinvest it if you can. And yes, some of it is taxed. It depends what accounts they're in. Weekly bearish engulfing as well for natural gas is what this person has. He's got the weekly death cross coming. Somebody wanted me to talk about it. I don't worry about the movements of these moving averages necessarily. Yes, you can have the death cross, but guess what, guys? You're underneath the cost of production. So whenever you get underneath the cost of this production, it would be best to actually cost average in. The people who look only at technical charts, I think, are at a big disadvantage than knowing the holistic approach of the cost curves, the fundamental analysis of all this stuff. You need to know both. Why? Because you can load up with more conviction and confidence in natural gas, in platinum, in silver, if you know where the cost curves are at. So these guys that just go off of the technical analysis, I think are just, I don't know. I don't think it's worth watching them. I think you need to know a little bit of both. And that's why I'm a hybrid. I'm a hybrid where are the cost curves at? Now, nat gas, there's a bunch of nat gas that gets cut off in the region of pricing where we're at today. I don't think there's going to be a chance where natural gas is going to stay down at $2 a million cubic foot for any length of period of time. Now, we could be down there for like 6 months, but I don't think we'll be down there for multiple years. I think it will be temporary, and I think we'll head on higher. So that's my take on it. I know somebody wanted me to make a take on this. The natural gas companies have all broken to the upside as well, which is further evidence that this of what they're looking at will probably only be temporary if it were to come back down. That's my take. Patrick says destruction of purchasing power is the name of the game, no matter the reasons. So this is the amount of fiat required to purchase a barrel of crude oil, and below is your ratio of basically crude oil to gold. So it's the amount of gold required to purchase a barrel of oil. It's flat. It goes sideways. What you're going to notice if you price things against things, assets against assets, is that it goes sideways in a valuation channel over time. The price in the US dollar goes up at a slant, which is the slant of inflation. So that is the name of the game is if you buy an asset and it just goes sideways over time, you're not actually increasing your purchasing power of that asset. You have to buy the undervalued asset that appreciates against the other asset. For instance, if you want to outperform an oil, if you bought it in 1980, wherever it is, 83, 4, 5, somewhere in here, and you rode it all the way up to this top portion here, you made a lot of purchasing power gains against gold. And then if you rode it back down, you could have gold, and then you ride it all the way back to the low point here. You increased your barrels of oil when you swapped to gold, rode it back down. Then you swap back to oil, and you ride it all the way back up. Then you swap back to gold at the peak here, ride it all the way back down, swap to oil. so on and so forth. That's how you increase your purchasing power. You don't want to buy an asset and hold it forever. That works well in individual companies that control the selling price of their product. You can hold that forever. That's a Warren Buffett approach, and it does work very well. Your long-term return will be your return on equity of the company. But in terms of commodities, you're going to have to swap back and forth of what's cheap and what's expensive. Here's U.UN. Sprout Physical Uranium Trust is about to take in a good chunk of cash to buy whatever physical uranium is left. We've got a gigantic break that could potentially be coming in the Sprout Physical Uranium Trust. You can also see kind of this shoulder head shoulder type deal going on. And we're about to break that resistance level that's holding it down. Things could move chaotic here. Things could break and really start to move to the upside. The projected target is $52 from 1820 or 1850, I think, is where it's at. 10,000 times the charm. This is the Sprout Physical Uranium Trust look differently. You can see where the volume nodes are on this guy on the left-hand side. We are just starting to break above this last volume node where we can really start to increase in price. There's not much overhead resistance on us. So get ready. Get ready. What I'm doing or what I've done already is I've got positioned in the companies I like. I'm going to sit in them. And when this thing rips, I'm going to take advantage of it. This was not a shoulder head shoulder. This, in my opinion, is the lead-in pattern for a much larger move. We are in the cycle for this move to occur. Everything is a tailwind for this to occur from a credit standpoint in the real estate cycle. Interest rates are generally going up during this portion of the cycle, or they're pausing. It's good to go here, guys. It's good to go. Looks like I accidentally hit the back button. So coming on down, it says there's a misconception out there that high-income earners can't contribute to a Roth IRA. The reality is there's a way to get around this. Contribute to a traditional IRA, ideally with no existing balance, but not required. Convert your traditional IRA to a Roth IRA. That's how I do it. It's called a backdoor Roth contribution. It says the trend is clear. And why would I do that? Roth IRAs, to contribute, you take after-tax money, put it in the account, and then you grow that money tax-free. That's why you'd want to do it. And that's the reasoning behind doing it. You want tax-free earnings when you take it out of that account of a Roth IRA when you're in retirement. The trend is clear. New home sales are surging, yet housing inventories remain at record lows. This means existing home sales are a omelet's dumpster fire as everyone remains stuck in their 3% mortgages and can't afford to sell. What I'll say is I purposefully got my 2.75% mortgage, so I don't have the increasing costs of living. I fixed one of my largest expenses. I fixed put a fixed rate mortgage on it, 30-year. That is called smart. If I want to buy something else, I will just buy another home eventually. That's how I will do it. So this is the big thing. New construction home sales remain high as overall inventory sits at an all-time low. So nearly 1/3 for sale homes are new construction. That is your real estate expansionary phase cycle. It is already coming into play here. New homes are going to have to enter the market to increase the number of homes in inventory or stock. That is the cycle. U.UN, that's a monster monthly candle for now, taking out the $18 level. Man, once that goes, we're going to rip it here. Agreed. This is yields. U.S. 10-year yield since 1913. There's your big increasing yield cycle from 1940s all the way up to 1981. This was your 35-year downtrend line. It's 40 years from the peak, all the way down to 2020, about 40 years. Now we're ripping to the upside. We've broken that downtrend line, and we are moving higher in yields. Money rotates differently in this environment than this environment. And now we're going back to an environment with increasing yields, higher inflation. So the money's going to rotate differently here, and people are not ready for that. It's going to rotate into commodities and precious metals. That's where it's going to go. And that's why we're seeing the launch pad of the Sprott Physical Uranium Trust, of energy moving up, of all these different commodities moving up. They're putting in all these big basing patterns. That is one of the drivers and another confluence of evidence to suggest that this is all going to occur. Peter says, smoothed out, U.S. oil inventories have drawn 6 million barrels per week the past 3 weeks, with more nice draws coming. Demand is breaking records just as deeper OPEC cuts hit. Spreads look good, cuts working, and market tightening as expected. Second half setup remains extraordinary. Happy Friday. If Bitcoin's adoption curve continues to grow along the slope of a typical power curve, it could take more than a year to revert to the old highs. What I'm going to say is, I don't like Bitcoin. I think people they're too confident in it. I am not nearly as confident as a lot of people. What happens if this were to crash below the cost curves of Bitcoin miners? And what happens to the costs to transact Bitcoin? I don't know what the answer is of that. Everyone looks at this like this is just going to continue to go up. They try to put these curves to it. They match a curve. That's called basically linear regression analysis. Well, it's not linear, but regression analysis. They fit some curve. They get an R squared value of how that curve fits the data, and then they say this is roughly what's going to happen. I don't know if that'll be the case. What if we come into a environment where things don't work out and this crashes down, and the whole thing, people get scared and money runs away from it? I just don't know. I haven't adopted it, and I don't think I ever will adopt Bitcoin. And there's going to be a lot of people that never adopt it. One thing that is kind of interesting that I don't know a good answer for is Bitcoin will die when all Bitcoin goes into a dead person's account and nobody can figure out how to get it out. Or when everything gets thrown away on a wallet that is in the garbage. It seems like that is possible. But I don't know. I'm sure someone in the comments section will disagree. Please tell me you completely pay off your credit card every month. You should be doing that, guys. It's not something that you want to use as you pay and then you have interest working in the opposite direction of you. That is working great for the bank because they're going to be collecting interest on those payments unless you don't pay it. But yeah, you don't want interest working against you. This is you got what I need. It says, will this play out? We take out that neckline as long as we're above that target is in play. I do expect to take profit at $80 on you got what I need. There's the inverted head and shoulders pattern that we're looking at. And we've got the neckline there at $11.58. Potential target $172. We also have some resistance at $80. A lot of people will say, what about all the dilution that this company has? Well, I mean, it depends on the value that this company has also created, and it depends on how ballistic uranium price goes. We don't know those answers. And I think this is very much possible that could happen. So I'll say that. Tavi says, stairs up, elevator down. The double top formation on the FANG Plus index has become more evident. As of today, the aggregate PE for these companies is approximately 45x or 29x the estimated earnings for next year. So these are the big boys, FANG Plus stocks. This could be a double top, and could have a much larger downside move. I agree. I've talked about this since 2021. I said, you know what? We're going to get a top. It's going to come up. It's going to break down. We're going to probably come up again. I said it could come at all these different levels. It could do a double top, and then it'll probably roll over again. Looks like he agrees with that. That's cool. Bitcoin with a 5 RSI, relative strength indicator reading. That should get investors seriously concerned. How many assets hit a 5 RSI or RSI reading, LOL. There's the 5.57, pretty rare. And I don't know if investors should worry. I don't know. I don't understand Bitcoin. I understand it well enough to know that I don't want to be in it. I'll just say that. If it was that great, since sliced bread or something like that, I would probably be in it. But I am not a Bitcoin believer. I haven't warmed up to it. Some people say go read the white paper. The white paper is not the reason I don't believe in it. I don't care about blockchain. All I care about is, well, how easy is this to use? How fast can you transact? And what are the costs to do it? From a use standpoint, it's pretty crappy. Now, why would someone store wealth in Bitcoin? What value does that have? And why would it retain that value? And how do we know how it's going to react in different market conditions? I don't have any of that data. It's too risky for me to speculate. If you've got all these different assets that are about to take off, why would I risk not gaining purchasing power? Now I know Bitcoin's done very well. It's absolutely smoked it in terms of purchasing power. It's probably one of the best sectors to perform. I just don't know, when something's new, I don't know how it's going to perform under certain market conditions. It's too much of an unknown and a risk for me to pile a bunch of money into it. U.UN, are you ready? There's the breakout and retest for the Sprott Physical Uranium Trust, and we'll see if this thing launches. More evidence of people seeing it. Here's wheat. Wheat has a 45-year parabolic base. Inflation's not done, not by a mile, unfortunately. Second inflationary wave is soon incoming. You have a big move to the upside for wheat and a lot of these other agricultural commodities, and a lot of them went up a lot today. Soybeans, wheat, and all these other ones. Cocoa. So I like sharing this. It says, wow, this video is a year old. Has the story changed from the Crash Bros? 2020 crash, 2021 crash, 2022 crash, 2023 crash. How many people did they hurt? Folks, you got to hear this. And that's that Nick Reventure Consulting guy who continues to say we are going to crash. There's a lot of people in 2020, 2021 calling for crashes. They don't understand the fundamentals. They don't understand the data, in my opinion. They don't understand the market conditions. But that's just me. Grady saying U.S. bonds had the 3 classic drives down from parabolic top. And now has a possible double bottom forming. A bounce would be reasonable here. And if bonds has a possible double bottom, then yields have a possible double top. He could be right. So this could be a shoulder head shoulder that we are going to create. Invertedly, if you look at the yields, we've come on up and we could get a pullback here to number 4. So is yield curve coming here? Is something going to come where we're going to yank yields down? Is a slowdown in the market going to force people into bonds? I don't know. And this is a possibility. When we go down in yields, it's going to blow up the real estate market. And that's where Powell is in a difficult position. If the markets slow down and the yields start to fall, I think the housing market's going to take off. I think we're also going to see gold take off dramatically to the upside in that type of market condition. We could also see commodities take off. So I don't know if he can. I think he's using the interest rates, and I think he's selling bonds to push the rates high to hold everything down in commodities. But if this were to come back down, I don't know. This is going to be very good for housing, and it's going to also, I think, be more inflationary, as weird as that sounds. But the yields would be coming down not because of inflation per se. It could be coming down because of market weakness for a period of time. And we'll see how that all plays out. I'm not predicting that this is going to happen, but we'll see. To get out of the rat race, one needs to work hard, strategy, stamina, mental shape, discipline, huge sacrifices, maximizing income, minimizing consumption, and to bet on the right market. This chart is setting up again and gives you which market to go for. So this is the commodity to stock market, and we've got that double bottom. Everything but commodities bubble. When this ratio moves up, commodities outperform the stock market by 36 times. That will be a combination of the stock market going down and commodities going up. And the double bottom is right what we're looking at. And we're at the bottom of the double bottom. This has a big move, big long runway to move to the upside. This was the last positive divergence on the relative strength indicator versus price. It's bullish. It means that we are strengthening even though the price hasn't really been following. It will follow, and it could be a dramatic shift to the upside. So that's what I've got for today, guys. That's what we're seeing on Twitter. A lot of good information there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. And I'll leave it at that. And we'll catch you guys next time. This is Finding Value.